Kia ora. It's Joe, and we're continuing to work for Tania Limited. Okay, so we've incorporated the company. We've done the initial share issue to K. Martin as consideration for his business. He received ordinary shares, preference shares, and we still owed him $250,000. After that, we went to the public with a share offering for ordinary and preference shares. The ordinary shares were oversubscribed, so we accounted for the oversubscription, allocation of shares in the accounts. Then after that, we also made a cash offer in November to the current ordinary shareholders. We made them an offer of one share for every 5 that they've got at the price of $1.05. 80% of those people subscribed, so we accounted for that, increasing the share capital, and we did that. And then in February 2016, the directors wanted us to do a share split on the preference shares. They wanted to give a 2-for-1 offering. So in other words, for every 1 preference share we ended up with 2. So the number of preference shares doubled, but we didn't raise any cash as such or any capital. It's just a matter of breaking the shares down a bit. So hey, look, they're typically halve in value, right? So that's what we've done there. And there's a number of reasons why people would split shares. One of them is because, so that they're probably more tradable. That is one reason. Moving on down, we're on to the next thing. Dividends. Right, time to pay the shareholders. All right, so we've got all these shareholders. It's the 28th of March. The directors meet, and having determined that the company satisfied the solvency test. Okay, we need to know about the solvency tests. There's a couple there. As directors, you need to make sure the company's solvent before you decide to give out dividends. So the next thing is they decide to give a dividend of 20 cents per ordinary share and for 18 cents per preference share, and they're payable on all shares held at the 1st of December 2015. All right, so how was holding shares at the 1st of December 2015? So ordinary shareholders, we had, here's the cutoff point, okay? So basically, we should only be having those people, okay? So that's 1,600. And then as far as the preference shares go, that was before we split them, okay? So there we go, all right? In some ways you can see that this is where the preference shareholders have done quite well, right? Because really they doubled the number of shares. They're getting 18 cents. Well, next time round they'll win out, okay? Because they'll have double the amount, right? Okay. So how many preference shares? Okay, it was only 350,000. What are we offering them? That's what we're offering them. 20 cents an ordinary, 18 cents a preference share. What does that add up to? That gives us our figure for our journal, right? So we can now say that what we're going to do is we're going to reduce our retained earnings. That's where we're paying it from, our profits. We're going to reduce our retained earnings by that amount, and then we're going to create the 2 liabilities, okay, from which we will pay out to the shareholders, right? So we create the liability in the accounts, and when we make the payments, it'll come journal to these accounts to zero them out. All right, so this isn't actually a cash disbursement journal. This is more recognizing that we've got dividends to pay. Okay, so there's the 320, there's the 63, and that totals up to what we're reducing our retained earnings by. So that's the journal to make a provision for the dividend. Obviously, when it comes to paying out the dividend, there's more transactions. All right. Right. Next exercise for Tania Limited. Tune into the next video.